I want to tell you something that changed my life, and I believe with every fiber of my being that it will change yours, too. You see, I spent decades watching the markets, not from some ivory tower, not from some distant place where numbers dance on screens without meaning, but right there in the thick of it. I watched fortunes made and lost. I watched men and women come into this game with hope blazing in their eyes, only to leave broken, confused, wondering what hit them. And for the longest time, I asked myself one question over and over again. Why? Why do some people seem to read the market like an open book, while others stumble in the dark? Why does the market take from the many and give to the few? And then, after years of observation, years of pain and triumph, years of watching the same patterns repeat themselves like clockwork, I discovered something. 3 laws, 3 simple, unchangeable laws that govern every single price movement you will ever see. And once you understand these laws, truly understand them in your bones, you will never look at a chart the same way again. Now, I'm not going to promise you overnight riches. I'm not going to tell you that trading becomes easy. But I will tell you this. These 3 laws are like gravity. They don't care about your opinion. They don't care about mine. They simply are. And every winning trade you've ever seen followed these laws. When I say that price is the only truth, I'm not saying it to sound clever or mysterious. I'm saying it because it took me years to unlearn everything else that distracted me from that simple reality. Early on, like most people, I thought markets were puzzles you solved with intelligence. If you read enough reports, followed enough smart people, or built enough theories, eventually the market would reward you for being right. That belief cost me time and money. Price doesn't respond to how smart you are. It responds to supply and demand expressing itself through numbers on a screen. Here's what most traders get wrong. They fall in love with explanations. They want reasons. They want stories. The market went up because of news. The market went down because of fear. This stock should rise because the company is strong. This asset must fall because it's overpriced. None of that matters in the moment you place a trade. Those stories might feel comforting, but they don't move price. Orders do. And price is the final record of those orders. It's the scoreboard. Arguing with it is like arguing with gravity. When I finally accepted that price doesn't care what I think, trading became much clearer. Before that, I was constantly negotiating with the market in my head. I'd say, it's gone down too far, or it can't go any higher, or the news is good, so this should work. The word should is poison in trading. Price never should do anything. It only does what it does. The moment you expect fairness or logic from price, you hand over control. Price doesn't know you exist. It doesn't know you just entered a position. It doesn't know you're nervous or confident or desperate. It's not waiting for confirmation from your indicators or respecting your support line because you drew it carefully. It's simply the result of millions of independent decisions being made every second. When you understand that, you stop taking movements personally. A loss stops feeling like an insult and starts feeling like information. One of the biggest breakthroughs for me was realizing that price action already contains all available information that matters for trading. Not in a mystical way, but in a practical one. Every fear, every hope, every prediction, every piece of news eventually shows up in price. By the time you hear the explanation, price is usually moved. So instead of chasing reasons, you learn to observe behavior. Is price accelerating or slowing? Is it persistent or unstable? Is it behaving the same way it has during past profitable conditions? Those questions are grounded in reality, not opinion. Most traders want the market to agree with them. Professionals want to agree with the market. That's a subtle difference, but it's everything. When you align yourself with what price is doing instead of what you want it to do, you remove friction from the process. You stop fighting trends. You stop averaging into bad ideas just to protect your ego. You stop holding losers because you know you're right. Price is always right, even when it doesn't make sense to you. I've seen incredibly smart people fail because they couldn't let go of their beliefs. They had a view, and they needed the market to validate it. When price moved against them, they doubled down instead of stepping back. They treated price as something to conquer instead of something to listen to. Intelligence without humility is dangerous in markets. Price humbles everyone eventually. When you truly accept that price is the only truth, discipline becomes easier. Decisions become cleaner. You don't need to predict the future. You only need to respond to what's happening now within a framework that has worked before. You stop trying to impress yourself with clever trades and start focusing on repeatable behavior. Over time, that consistency adds up. This mindset doesn't make trading easy, but it makes it honest. You no longer hide behind excuses. If a trade fails, it's not because the market was irrational. It's because the conditions you rely on didn't produce the expected outcome this time. That's part of the game. You adjust, you learn, and you move on. No drama. No revenge. No stories. Once you internalize this, charts stop being emotional triggers and start becoming neutral data. You see price not as something attacking your account, but as information flowing in real time. That shift alone separates most losing traders from the ones who last. And if you remember nothing else, remember this: the market never owes you clarity, fairness, or profits. The only thing it ever gives you is price, and price is enough if you learn how to respect it. When I say that trading is a probability game, not a prediction contest, I'm pointing to one of the hardest truths for most people to accept. Human beings are wired to want certainty. We want to know what's going to happen next. We want reassurance before we act. Markets don't work that way. If certainty existed, there would be no opportunity because everyone would already be positioned the same way. The very reason trading works at all is because outcomes are uncertain and unevenly distributed over time. Early in my career, I made the same mistake almost everyone makes. I judged myself by individual trades. If a trade won, I felt smart. If it lost, I felt foolish. That emotional roller coaster had nothing to do with skill and everything to do with misunderstanding probability. One trade is a meaningless data point. Even 10 trades can lie to you. The truth only reveals itself over a large enough sample size where randomness starts to cancel out and the underlying edge becomes visible. This is where most traders sabotage themselves. They find a setup that works, take a few losses in a row, and abandon it. Or they win a few trades and suddenly believe they've cracked the code, so they increase size recklessly. Both behaviors come from treating trading like prediction instead of probability. When you think you're supposed to be right on every trade, losses feel like failure. When you understand that losses are expected, they lose their emotional charge. Probability thinking changes how you experience uncertainty. Instead of asking, "Will this trade win?" you ask, "Does this trade fit my edge?" That's a completely different mindset. You're no longer trying to control the outcome of a single event. You're managing a process that plays out over time. Casinos understand this better than anyone. They don't care if someone wins a hand. They care that the rules give them a small edge over thousands of hands. Trading works the same way. When we built models, we never assumed any single trade mattered. What mattered was whether the system produced favorable results across many repetitions. Some days looked terrible. Some stretches tested patience. But over time, the math asserted itself. That's what probability does when you let it work. The people who fail are usually the ones who interfere with the process because they can't emotionally tolerate short-term variance. Another important part of probability is accepting that you can do everything right and still lose money on a trade. That idea makes people uncomfortable, but it's essential. If you believe that a loss means you made a mistake, you'll constantly second-guess yourself. You'll tweak rules that don't need fixing. You'll over-optimize and eventually destroy your edge. Losses are not feedback about your intelligence. They're part of the distribution. Once you internalize this, fear starts to fade. You no longer enter trades hoping they work. You enter trades knowing some won't, and that's fine. That acceptance is incredibly freeing. It allows you to execute cleanly instead of hesitating. Hesitation usually doesn't come from lack of knowledge. It comes from fear of being wrong. Probability thinking removes the need to be right. It also changes how you handle winning streaks. When you see gains as part of a probabilistic process, you don't get euphoric. You don't assume you've suddenly become special. You stick to the same rules that got you there. Overconfidence is just as dangerous as fear, and both disappear when you stop focusing on individual outcomes. Most people say they understand probability, but their behavior says otherwise. They widen stops after losses. They cut winners early because they're afraid of giving profits back. They constantly adjust because they think the market has changed after a small sample of trades. All of that comes from mistaking randomness for information. Real information only appears over time. When you truly accept that trading is a game of probabilities, patience becomes a competitive advantage. You stop rushing. You stop forcing trades. You let opportunities come to you. You allow your edge to express itself without interference. That's when consistency starts to appear, not because you're predicting better, but because you're behaving better. The irony is that once you stop trying to predict, your results often improve dramatically. You're no longer attached to outcomes, so you execute more faithfully. You size positions appropriately. You survive losing streaks without emotional damage. And survival is underrated in trading. If you stay in the game long enough with a real edge, probability eventually works in your favor. This way of thinking doesn't just apply to markets. It changes how you approach uncertainty in life. You stop demanding guarantees before acting. You focus on process instead of perfection. And that shift, more than any indicator or strategy, is what separates traders who burn out from those who endure, because in the end, the market doesn't reward the best predictions. It rewards the people who understand probability well enough to stay consistent through uncertainty. When I say that losses are not personal failures, I'm talking about one of the most emotionally difficult lessons in trading, and also one of the most liberating. Most people walk into the market carrying their ego with them, whether they realize it or not. They connect their self-worth to their results. When they win, they feel validated. When they lose, they feel exposed. That emotional attachment quietly destroys more trading accounts than bad strategies ever could. A loss feels personal because people believe it says something about them. It feels like proof that they weren't smart enough, patient enough, or disciplined enough. But the market isn't judging you. It's not handing out grades. It's not keeping score of who deserves to win. A loss is simply one outcome in a probabilistic environment, nothing more. The faster you accept that, the less power losses have over your behavior. Early on, I took losses personally too. I'd replay trades in my head, looking for someone to blame, usually myself. I'd ask, "Why didn't I see that?" Or, "How could I be so wrong?" That kind of thinking assumes that the market is supposed to reward correct thinking and punish incorrect thinking. It doesn't. It rewards edges over time. You can have the right idea and still lose. You can have the wrong idea and still win. That's not unfair. That's probability. The danger of taking losses personally is not the emotional discomfort itself, but what it causes you to do next. People revenge trade. They increase size to make it back. They abandon good systems after a few losing trades, or they become so cautious that they stop taking valid opportunities altogether. All of those reactions are emotional responses, not rational decisions, and price punishes emotional behavior without hesitation. Once you truly understand that losses are part of the cost of participation, your relationship with them changes. They stop feeling like wounds and start feeling like expenses. No business owner shuts down a profitable company because they had operating costs. Trading is no different. Losses are operating costs. The goal isn't to avoid them. The goal is to make sure they're smaller than your gains over time. Another mistake people make is assuming that a loss means something needs to be fixed immediately. Sometimes it does. Often it doesn't. In a probabilistic system, losing streaks happen even when nothing is broken. If you constantly tinker in response to normal drawdowns, you end up chasing noise. You turn a stable process into a fragile one. Emotional discomfort tricks people into thinking action is required when patience is the correct response. Separating your identity from your trades is critical. You are not your last trade. You are not your equity curve this month. You are the person executing a process. Judge yourself on execution, not outcome. Did you follow your rules? Did you size correctly? Did you exit when you said you would? If the answer is yes, then the trade was successful even if it lost money. That mindset is uncomfortable at first, but it builds long-term resilience. There's also a subtle form of arrogance hidden in taking losses personally. It assumes that you should be exempt from randomness, that if you do things right, uncertainty should disappear. Markets don't work that way. Accepting uncertainty is a form of humility, and humility is a survival trait in trading. The market humbles everyone eventually. The question is whether you learn from it or fight it. When losses stop feeling personal, fear loses its grip. You stop hesitating on entries because you're afraid of being wrong. You stop moving stops because you're afraid of being stopped out. You stop clinging to losing trades because you don't want to admit defeat. Those behaviors come from ego protection, not strategy. Remove the ego, and execution becomes much cleaner. This shift also improves your ability to learn. When you're not emotionally defensive, you can analyze losses objectively. You can see patterns without shame or denial. You can improve without self-judgment. Growth becomes easier when failure isn't an identity threat. Ironically, people who are hardest on themselves often learn the slowest because they can't look at mistakes clearly. Over time, this mindset builds emotional endurance. Drawdowns don't shake you as much. Winning streaks don't inflate you as much. You stay closer to neutral, and neutrality is powerful. It allows you to show up each day and execute the same way regardless of recent results. Consistency comes from emotional stability, not motivation. The market doesn't reward confidence or punish doubt. It rewards those who can stay rational in an environment designed to provoke emotion. Losses are one of its main tools for doing that. If you interpret them as personal failures, you'll always be reacting. If you see them as part of the structure of the game, you'll start responding instead. In the end, the goal isn't to eliminate losses. That's impossible. The goal is to eliminate the damage they do to your thinking. When you can lose without losing your discipline, you gain something far more valuable than a winning trade. You gain the ability to stay in the game long enough for your edge to matter, and that's where real progress begins. When I say that discipline beats intelligence, I'm not trying to diminish intelligence. I'm pointing out that in markets, intelligence alone is rarely the limiting factor. Most people who trade are smart enough. They can understand charts, indicators, and strategies. They can read, study, and analyze. What separates outcomes isn't how much someone knows, but how consistently they can apply what they know under pressure. Markets are environments designed to test discipline. They tempt you when you should wait and scare you when you should act. They reward patience slowly and punish impatience quickly. Intelligence loves complexity. Discipline thrives on simplicity. A highly intelligent trader can invent reasons to break rules faster than a disciplined trader can stick to them. That's why intelligence, without structure, often becomes a liability. I've watched people with extraordinary analytical ability struggle because they couldn't follow their own rules. They would see something interesting and take a trade outside their system. They'd justify it with logic that sounded reasonable in the moment. When it worked, it reinforced bad behavior. When it didn't, they'd feel unlucky. Over time, those small lapses compounded into inconsistency. Discipline isn't about being rigid. It's about respecting boundaries you set when you were thinking clearly. Discipline shows up in the unglamorous moments. It's closing a trade when your stop is hit instead of hoping it turns around. It's taking the same setup after 3 losses in a row because the rules say you should. It's not increasing size because you feel confident after a winning streak. None of those actions feel heroic. They feel boring. But boredom is often a sign that discipline is doing its job. One of the reasons discipline matters more than intelligence is that markets constantly change. What worked in one environment might stop working in another. Intelligent traders often try to outthink that change in real time, adjusting too quickly and too often. Disciplined traders rely on predefined criteria to signal when change is real and when it's just noise. They don't react emotionally to every fluctuation. They wait for evidence. Discipline also protects you from yourself. Everyone has psychological biases. Fear, greed, overconfidence, and regret don't disappear just because you're smart. In fact, smart people are often better at rationalizing emotional decisions. Discipline acts as a firewall between impulse and action. It turns trading into execution rather than improvisation. Another overlooked aspect of discipline is repetition. Edge comes from doing the same thing well over and over again. That kind of repetition is uncomfortable for the mind. The brain craves novelty. It wants to feel clever. Discipline requires you to resist that urge and trust the process. Over time, small advantages compound, not because you were brilliant in one moment, but because you were consistent across many moments. People often mistake discipline for willpower. It's not about forcing yourself to do the right thing through constant effort. True discipline is about designing systems that make the right behavior easier and the wrong behavior harder. Position sizing rules, entry criteria, exit rules, and risk limits exist to remove decision-making in moments of stress. When those rules are clear, discipline becomes sustainable. Without discipline, intelligence becomes unstable. You might have flashes of success, but they won't last. Inconsistent behavior produces inconsistent results, and inconsistency makes it impossible to learn because you never know whether outcomes came from skill or impulse. Discipline creates a clean feedback loop. You can see what works and what doesn't because your behavior stays relatively constant. Discipline also brings emotional balance. When you know you're following your plan, you don't feel the same anxiety during trades. You don't need to watch every tick. You don't feel compelled to interfere. That calm isn't confidence in being right. It's confidence in your process, and that kind of confidence is much more durable. The market doesn't reward brilliance in bursts. It rewards reliability over time. It rewards the trader who shows up the same way on good days and bad days. Intelligence can help you build a good plan, but only discipline can execute it consistently. Without execution, ideas are worthless. In the long run, the trader who makes fewer emotional decisions often outperforms the trader with the most sophisticated analysis. That's not because the market is simple, but because humans aren't built to handle uncertainty gracefully. Discipline compensates for that. It keeps you aligned with your edge even when your emotions disagree. Eventually, discipline becomes a form of freedom. You stop debating with yourself. You stop second-guessing every move. You know what to do, and you do it. That clarity reduces stress and improves performance at the same time. And once you experience that, you realize something important. Intelligence may open the door, but discipline is what keeps you in the room long enough for success to compound. When I say the market isn't the enemy, expectations are. I'm pointing to a quiet problem that ruins more traders than bad entries ever will. People don't come to the market just to trade. They come with hopes, timelines, and assumptions about how things are supposed to work. They expect consistency too quickly. They expect profits to feel smooth. They expect effort to be rewarded in a linear way. And when reality doesn't match those expectations, frustration shows up. The market itself isn't hostile. It isn't trying to trick you or take something from you. It simply reflects collective behavior under uncertainty. The pain traders feel usually comes from the gap between what they expected to happen and what actually happened. That gap is where anger, fear, and doubt lie. Close that gap, and the emotional struggle decreases dramatically. Many traders expect the market to make sense in the way other areas of life do. If you study harder, you get better grades. If you work longer, you earn more money. Trading doesn't follow that pattern. You can do everything right and still have a losing month. When people aren't prepared for that, they interpret it as something being wrong, either with the market or with themselves. That interpretation fuels bad decisions. Expectations also create urgency. People come in expecting fast results. They expect to turn a small account into something meaningful in a short time. That pressure pushes them to overtrade, oversize, and force opportunities that aren't there. The market doesn't reward urgency. It rewards patience. When expectations are unrealistic, patience feels unbearable. Another common expectation is that once you figure things out, trading should become easy. It doesn't. It becomes clearer, but not easier. Uncertainty never disappears. Losses never stop completely. Drawdowns still happen. Traders who expect a finish line where stress ends are constantly disappointed. The ones who last are the ones who accept that uncertainty is permanent and manageable, not temporary and solvable. Expectations also distort perception. When you expect a trade to work, every small pullback feels threatening. When you expect to lose, every move against you feels like confirmation of failure. Price itself hasn't changed, but your emotional reaction has. That reaction comes from expectation, not information. Removing expectation allows you to see price more objectively. One of the most damaging expectations is the need for validation. People want the market to confirm that they're smart, disciplined, or improving. When a trade loses, it feels like rejection. That emotional interpretation turns trading into a personal struggle instead of a technical one. The market doesn't validate effort. It reflects probabilities. Looking for validation in price is a guaranteed source of disappointment. When you let go of expectations, something interesting happens. You become more present. You stop projecting outcomes and start observing behavior. You no longer need the next trade to fix the last one. You focus on execution instead of recovery. That shift alone improves decision-making because decisions are no longer driven by emotional debt. Letting go of expectations doesn't mean you stop having goals. It means you separate goals from short-term outcomes. You aim to execute well today, not to force profits today. You understand that progress shows up unevenly. Some weeks feel stagnant, some months surprise you. That variability stops feeling like a problem and starts feeling normal. The market often feels cruel to people who demand certainty. It feels unfair to people who expect symmetry between effort and reward. It feels chaotic to people who expect control. But when you remove those expectations, the market becomes neutral. It's just data moving in response to participation. Neutrality is powerful because it reduces emotional noise. This mindset also changes how you handle mistakes. Without expectations of perfection, mistakes become part of learning instead of proof of inadequacy. You correct them without shame. You improve without self-criticism. That emotional flexibility makes long-term growth possible. Rigid expectations make growth painful and slow. Over time, releasing expectations builds resilience. You're less shaken by losing streaks because you expected variance. You're less euphoric during winning streaks because you expected regression. Emotional extremes flatten out. What remains is steadiness, and steadiness is a competitive advantage in markets. The irony is that when you stop expecting the market to give you something, it becomes easier to take what it offers. You notice opportunities without forcing them. You accept losses without spiraling. You stay engaged without burning out. The struggle fades, not because the market changed, but because your relationship with it did. In the end, trading becomes less about fighting uncertainty and more about cooperating with it. You stop demanding outcomes and start respecting process. You realize the market was never against you. It was simply responding to behavior, including your own. When expectations loosen their grip, clarity takes their place, and trading becomes not just more effective, but more sustainable over the long run. I want you to pause for a moment and really think about everything we've talked about, because none of this works if it stays as information. Markets don't reward people for what they know. They reward people for what they consistently do. And the shift I'm asking you to make isn't a technical one, it's a mental one. If you've been struggling with trading, it's probably not because you lack intelligence or effort. It's more likely because you've been fighting the nature of the market instead of working with it. You've been trying to predict instead of prepare. You've been trying to be right instead of being consistent. And you've been expecting the market to behave in ways that make you feel comfortable. Comfort is expensive in trading. Everything changes when you stop asking the market to make sense to you and start asking yourself whether you're responding to what's actually happening. Price doesn't send messages. It doesn't explain itself. It doesn't apologize. It just moves. Your job is not to argue with it or interpret it emotionally, but to read it objectively and act within rules that protect you when you're wrong and let you benefit when you're right. The truth is, trading isn't about control. If control is what you're after, this is the wrong arena. Trading is about acceptance, accepting uncertainty, accepting losses, accepting that even your best ideas will fail sometimes. That acceptance doesn't weaken you. It stabilizes you. And stability is what allows skill to compound over time. A lot of people quit right before things start to click, not because they weren't capable, but because the emotional weight became too heavy. They carried expectations that the market was never designed to meet. They thought progress would feel smoother. They thought confidence would mean fewer losses. They thought experience would remove doubt. None of that is true. What experience gives you is the ability to act despite doubt, to stay disciplined despite discomfort, and to keep showing up despite uncertainty. If you take anything from this, let it be this idea: the goal is not to eliminate emotion, it's to prevent emotion from making decisions for you. Fear and excitement will always show up. The difference between those who last and those who don't is whether those emotions get a vote. Structure, discipline, and probability are how you take voting power away from emotion. You don't need to be faster than the market. You don't need to outthink everyone else. You don't need a perfect strategy. You need a repeatable process and the patience to let it work. That's it. The rest is noise. The market is incredibly efficient at punishing impatience and incredibly generous to those who respect time. Trading becomes much simpler when you stop trying to impress yourself, when you stop chasing the perfect trade and focus on executing the next correct action. One trade at a time, one decision at a time. That simplicity doesn't come from ignorance. It comes from understanding what actually matters. If you're early in your journey, understand this now so you don't have to learn it the hard way. Losses don't mean you're failing. Slow progress doesn't mean you're behind. And uncertainty doesn't mean you're doing it wrong. It means you're participating in a system that rewards endurance more than brilliance. And if you've been at this for a while and feel frustrated, maybe the answer isn't more complexity. Maybe it's fewer expectations. Maybe it's trusting what you already know and executing it with more consistency. Progress often comes from subtraction, not addition. At the end of the day, the market doesn't need you to believe in it. It doesn't need your confidence or your conviction. It only responds to behavior. When your behavior aligns with probability, discipline, and realistic expectations, results follow in their own time. So take a step back, respect price, respect risk, respect yourself enough to stay disciplined, even when it's uncomfortable. If you can do that, you won't just become a better trader. You'll develop a way of thinking that carries into everything else you do. If this resonated with you, take it seriously. Rewatch it. Let it sink in. These ideas don't change your trading overnight, but they do change the direction you're heading. And direction matters more than speed.